This podcast contains general information only and doesn't take into account your personal financial situation or goals. Welcome to Fit for Business with Sonja Pfitz, Episode 3, How to Get Prepared Before Seeking Finance. Thanks for joining us. In the coming episodes, we'll take a deeper dive into how to get prepared before seeking finance and the financial reporting that you'll need to have ready when applying for a loan or restructuring your existing financial arrangements. Plus, we'll be discussing strategies on how to ease your cash flow problems with specific, easy-to-follow strategies and financial products that can support your business.
Welcome back, everyone, to episode 3 on how to get prepared before seeking finance. So as we've discussed in the previous episodes, the increase in the cash rate has changed the lending landscape, impacting both consumer and commercial lending, providing many challenges for business owners. So before you take the deep dive into buying that next piece of equipment, vehicle, commercial property, or even an overdraft, let's take a look at how we can get prepared before seeking finance or even restructuring your existing financial arrangements. With this information, it will allow you to be better prepared to make informed decisions on the lenders that can support you, the timing it takes to borrow these funds, and ultimately we aim to reduce the stress out of the lending process. It is important to understand the lending landscape is changing and the lenders' requirements and appetites have evolved in terms of the type of lending they will provide, the rates, and the type of clients they actually want. So where do we start? Step 1. Planning with the right support structures in place is key. This entails having both your commercial finance broker and your accountant, whether that's internal or external accountant, to support you in this process. Once we have those support structures around us, the next step is really around having the following reporting and statutory requirements up to date. This is vital for a smoother lending process, and your business broker or commercial banker is not trying to make your life difficult by asking you for all this paperwork. It's simply what the lenders need in this environment to assess your borrowing capacity and which lender is the right fit for your requirements and situation. So let's take a look at these 6 things that you need to have in place. Firstly, your financials. These must be up to date in terms of your FY22s must be at a minimum finalised and your company tax returns lodged. Secondly to that, ensure that your management accounts are reconciled and prepared to the previous financial year. So when we're talking FY23, we're talking about the 30th of June 2023. We're not asking them to be finalised at the time we're doing this recording, of course, but they need to be completed in a draft format and reconciled back to previous years. The reason that these financials are so important is it gives not only your commercial broker but the lender an understanding of how the business has been trading and a baseline for where you're actually going forward, which brings us to the next thing that you should have available, and that's a forecast, both a sales forecast and a profit and loss. So the financials we just talked about is how the business has traded in the past. The forecast can be built off those trading financials to assess how you're going to travel forward. So a picture of the past and a picture of the future. Next most important report that we need to have, or it's really a statutory obligation, and that is your ATO. We've seen many reports in the papers recently. The ATO has been out there discussing how they're going to make their presence more known by calling in the billions of dollars of tax that is still owing by businesses. So ensuring that you have your ATO lodgements up to date and paid, or at a minimum put on an ATO payment arrangement. Now this is key because if you have tax arrears, it is really going to limit the level of lenders that you have available to you. And in some situations, depending on your tax debt level, it may preclude you from getting lending at all. You certainly don't want to have the ATO chasing you, so it's important to work with your accountant to get those lodgements done, up to date and paid, or at a minimum put onto a payment arrangement. The next thing we need to consider is making sure that we have clean and reconciled receivable and payable ledgers. Well, you might say, well, Sonja, what's a receivable and payable ledger? Well, your receivable ledger is what your customers actually owe you, and your payable ledger is what you actually owe your suppliers. And in many situations, we always want to see the level of amount that's owed to you from your customers is higher than what you owe your suppliers. That's a nice place to be in. It's not always relevant for some industries where their customers might actually pay them faster. For example, they might get paid in 14-day terms. But a good, healthy business will have their receivable ledger higher than their payables ledger, but most importantly, well aged. We don't want to be seeing debts on either of these ledgers sitting in 90 plus days. That shows that you have an unhealthy cash flow in the business. Sure, there are some customers, particularly if you're dealing with the majors, that may impose trading terms on you, which are 60 days from end of month, and that will slightly distort the aging of your ledger. But in this current environment, cash is king, so try to look at your trade terms, both for your customers and your suppliers. The next thing that we need to look at, which is also critical, is credit cards and existing debts. When we're going through the lending process, the lenders will assess your existing financial commitments with other lenders. Do you have credit cards because they are a debt into the business? Please make sure that you try to bring them up to date, or ensure that they're brought up to date, or reduce them where you can. A lender will not see favourably to you if you have not been paying those debts on time, you've had defaults continuously, or you have debts within the business that can really be removed. And what I'm particularly talking about there is credit cards. Quite often we've been in the past in an environment where credit cards have been handed out quite freely from lenders, and people have just taken them up and used them. That can put you into a bit of a bad habit in terms of using them rather than looking at a proper financial structure on how to pay your debts. But if you have credit cards that you are not using, I suggest that you actually cancel those credit cards, because even if you're not using it, the limit that is applied to that credit card is considered as a debt in the business. Really important. So have a look at your existing arrangements and making sure that they're up to date. And if you have credit cards that you don't use, consider removing them. So whilst these 6 points are not the extensive list that a lender will ask you, it does give both your commercial broker and the lenders a good understanding of how the business is performing, the financial management of the business, and it does apply to the lending calculations that the lender and both the commercial broker will actually apply to see whether you have the capacity to borrow money and whether you have the capacity to repay those debts without placing you into financial hardship. So when we're going through these next steps, again, we're not trying to make your life difficult by asking for these reports. It is the foundation level to assess the business and get an understanding of how we can assist you, the right lenders that might be able to support you, and most importantly, can you actually have the capacity to borrow this money and repay this money without creating financial distress. The next step is really about building the application and creating a story, a client briefing for the lenders to understand you and your business, what your objectives are and what you're trying to achieve. So your broker will talk to you about things like interest rates, variable interest rates, fixed interest rates, secured and unsecured lending. This language sometimes can be a bit confusing, but we try to express and explain as simply as we can how this impacts the whole lending process. Interest rates, as we know, they vary depending on the type of lending that you are applying for. It depends on whether the type of lending you're looking at is secured and unsecured. It also depends on the lender that you're applying for a loan with. So clearly, as we know, the banks obviously will have the cheaper rate compared to a tier 2 or 3 lender. These all have impacts on the lending process, which your commercial finance broker will talk to you about in detail. The next key step is calculating serviceability. And you'll say, well, Sonja, what is serviceability? Serviceability is basically a calculation that's done on your existing business to see if you're taking on new debt or restructuring your debt. Do you have the capacity to repay that debt within the time frame of which you're applying for that loan? And that might be a loan for 12 months, it might be a loan for 5 years or 10 years or 15 years. Do you have the capacity to pay it back without putting stress on the business? Now, these serviceability ratios that the lenders apply to any lending situation have dramatically increased, and is the initial step that both your commercial broker and the lender will take before an application is lodged. If you don't service up for the loan that you're wanting to undertake or the restructure of your existing financial situation, your commercial broker will tell you. So we might have Pat say to me, Sonja, I want to have $1 million overdraft in the business or a $500,000 overdraft in the business. But when I've done the calculations, the serviceability calculations, I might say, Pat, you don't quite qualify for $1 million or even $400,000, but you do qualify for $300,000. Now, sometimes those numbers are hard to hear because it's not within the expectation that you had of where you thought you could borrow funds. So we need to make sure that we carefully step you through that you understand your capacity to borrow and what level of funding you can borrow to. Again, this can be impacted slightly by security that's been provided, but ultimately it's can the business actually repay the debt over the period of time of which you're actually borrowing those funds.
Did you know many businesses fail due to inadequate funding, poor credit controls, or inexperience? That's why you need this podcast, Fit for Business with Sonja Pfitz.
Next, a really important topic, and we talked about this, that's credit scores. So in episode 1, we talked about credit scores and what they are and how they're applied to the lending situation. Credit scores are applied not only to the business, but also to the directors of the business. And they are really important to understand and for you to really understand what your scoring is. So lenders will heavily rely on credit scores to assess whether a client is within their appetite. It impacts their risk policies, but also it will determine with the commercial broker which lenders you will actually fit into, which lenders are options for you in terms of what you're trying to achieve. So if we look at what is a credit score basically looks at your past history on how you've paid back your debts. It looks at have you ever had defaults or judgments placed against you or the business? Have you been involved in a failed business before? It also looks at the industry that you're in and also down to the location of where your business is operating. So lenders spend a lot of money every year working with external groups to assess the economy, assess industries, assess locations, and all of these components add to the algorithms that work out the credit scores. Equally so, if you've been applying for a lot of loans over a short period of time, that will impact your scoring in a negative way. Lenders will start to ask, why are you applying for so many loans? Why have you applied to so many different lenders? And have they been approved or have you been knocked back? So it's important to understand credit scores and how that will impact your ability to borrow money, and understand where your credit score sits not only for your business and yourself. So if we look at the credit score range, which is 0 to 1,000, some lenders will have a risk policy that says we do not lend money to people who have credit scores below 700. Your commercial finance broker will know this and therefore be able to speak with you about the range of lenders that you have based on your scoring and your serviceability calculations. It is important for you to understand, why is my score the way that it is and how can I improve it? Talk to your commercial finance broker on how to improve your score, and it may mean that lending at this particular time, if your scoring is very low, is not the right time to be borrowing money or seeking finance. There may need to be improvements both in the business's behaviour and trading performance, and equally so changes in your behaviour and the way that you're paying your debts back. So once we get through those two key components, outside of looking at the financials and the performance of the business, we've calculated the serviceability for the loan or restructuring your whole financial situation. We've looked at the credit scores and they're all in alignment. Your commercial broker will then actually say to you, these as your options in terms of lenders. These are your options in terms of the lending products that are going to meet your objectives and requirements. So that's great. We say, fantastic. We've got the lender we want. We know the product that's going to meet our requirements and objectives. But, okay, we're ready to do the application now. How long is it going to take? How long will it take for me to get an approval? And it may not be exactly the way that we'd hope the approval would come back, and we'll talk about that in a moment. But we need to be truthful on the timeframes for the loan assessment. As we've mentioned in previous episodes, all lenders are suffering staff shortages, just like every industry. So this can impact their ability to turn around loan applications quickly, although most lenders do try their best. As we've mentioned too in the past, the more complex your corporate structure is, or the larger the loan that you're borrowing, it will take time. And we can see, and I've seen this personally, some loan assessments are taking up to 10 or 12 weeks to come through. So before you embark on the lending application process, this is a key question you should be asking your commercial broker. How long is this process going to take? Because it could impact on what you're trying to achieve in the business in terms of getting cash into the business to meet new contracts, purchasing new equipment to meet upcoming obligations or projects that you've got, ability to take on a much cheaper volume of raw materials. So it is important to understand how long it's going to take to get an approval. There is no crystal ball, and most lenders are trying their best to do it in a shorter time frame as possible. But knowing these expectations up front will help lower your stress levels, particularly when you're really relying on new lending into the business to support an objective that you're trying to achieve in your company. As the economy's changed and lenders are changing their appetites, we are also seeing diminishing number of lender options in the market for specific products. So we see lenders will take up a product and then later on they'll drop the product. We'll see some lenders merge, some lenders will actually drop out of the industry completely. So it's important for your commercial broker to discuss with you when you're taking on a specific product, whether it's asset and equipment finance, it might be invoice finance or trade finance, which reputable lenders are operating in that particular space who offer these products. The last part, as we've said, is when we're circling really back around to the ATO debt. If you have large ATO debts or even debts in general, this will narrow the field or limit the lender options that we have available that can support you. So again, really important to make sure you've got these ATO debts under control or paid in full. There are some lending solutions that we'll talk about in upcoming episodes that can address your tax debt and have those cleared and paid through taking on a particular type of financial product to support you in that process. So important to have a look at those. But again, if you have tax debt, it will limit the lender options available. And lastly, when we're looking at lenders in this process, the loan application has gone through, it's approved, knowing that all lenders will have conditions that will be placed on certain types of financial products that are being offered. We call them covenants in our industry, but it's essentially just a condition. And what that means is you must make sure that you adhere to these conditions so that you don't default on your loan or that you don't drift outside of it and therefore causing action for the lender to change the parameters of the lending solution that they've actually provided you. Secondly to that, some lenders will ask for regular reporting throughout the life cycle of your loan that you have with them. You need to make sure that you have the capability to provide that reporting on time and when required so that you don't have a situation where the lender might pause your facility. They might actually ask for a debt reduction in your facility. So these two things, both covenants and reporting requirements, are really important to understand before you agree to the loan that's been approved for you. One thing that I do like to ensure clients undertake is before you sign any documentation, be it the loan approval or the legal documents provided by the lender, get your solicitor to have a look at these documents so that you fully understand your obligations when engaging in this loan and taking on this loan or lending facility. There are also some hidden fees and charges that may not be presented to you upfront but are within those contracts. So it's important that you fully understand any hidden fees and charges that may not have been disclosed upfront but are within the documents, because you don't want to have a nasty surprise down the track if, for instance, that you aren't meeting a covenant or a reporting requirement and a lender then says, okay, well, you're now in default of the facility, we're now going to apply these fees or charges. It doesn't happen for every lender, but you need to make sure you understand the facility that you're getting involved with and understanding the legal ramifications if you don't meet all of your obligations in undertaking a loan or a lending facility. So understanding what the true cost of your borrowing really is. And lastly, but not least, customer service. We've talked about this previously, relationship. It is important to have a good relationship not only with your commercial finance broker and your accountant, but with the lender that you're about to engage with, whether it's for a year, 5 years, 15 years. You want to make sure that you're working with a lender that you can have a good relationship with, that will understand your business and support you on your journey through. So I'm hoping that this episode has given you a brief summary on how to get prepared before seeking finance or even restructuring your existing financial arrangements.
Sonja Pfitz has been a commercial finance strategist for SMEs, working in the finance industry for over 27 years. This podcast series is designed to inform you about the lending landscape for your business and to help you implement the right financial solutions to achieve your strategic objectives. Thanks for listening and look forward to having you join us in the next episode of Fit for Business with Sonja Pfitz.